Is private credit starting to break? Is consumer spending slowing down? And the AI wars are heating up. These topics and the team's take on Gamestop on this week's episode of Investment Insights by Opal. Thanks for tuning in to this episode. My name is Jay Coulter. Joining me as always, Adam Mueller, Austin Graff. If you'd like to ask the team a question, feel free to shoot us an email, podcast@Opal Invest, or scan the QR code on the screen right now. Let's start off with what happened last week. All three major indexes declined as volatility ticked up. In a role reversal, technology and industrials lagged, while energy and real estate were the leaders last week. Economic data indicated that core personal consumption expenditures rose by 0.2%, in line with expectations, but it also looks like consumer spending may have slowed. And corporate buybacks set a record in May, indicating corporate America is flush with cash, but has few places to invest outside of their own shares. Austin, what's your take on last week?
Yeah, I think it's a relatively unique time right now where we're seeing the top-down macro data come across as being relatively resilient and positive, but we're seeing the perception from underlying consumers, and quite frankly, the numbers on a number of consumer companies show that there's a bit more shakiness under the surface. So it'll be interesting to see what the Fed does from here, given the Fed seems to be driving the market.
Adam, what's your take?
Well, the corporate buyback data is disturbing to me because basically what it's suggesting is that companies look out there and say, you know what, all the assets we're seeing are too expensive to buy, so we'll just buy ourselves. But guess what? You're also expensive. You know what was a big year for corporate buybacks, for share buybacks? 2007. And if you'd waited 12 to 36 months, you could have bought your shares for half the price. So it's a weird indicator that most companies have a terrible track record at the timing of their buybacks. They do it when they're flush with cash, when their margins are peaking, and when things are about to fall off a cliff. So that's a little disturbing to see.
Adam, why do you think this gets so much attention politically?
Oh, it's a great question. It's a great question, and I think it all comes back to earnings. You know, earning margin. You're at a peak margin. You're at peak margins. You're flush with cash. You're generating a lot of net income, a lot of free cash flow, and you don't know what to do with it, so you buy back your shares. The politicians look at that and say, "Wow, maybe we should be taxing you more if you have so much money that you can just throw it at your expensive shares." I think that's a part of it. And look, it's an election this year, particularly. It's an election year. So if you think you can get some votes by going after corporate America as a politician, of course you will, because that's what you do.
Yeah, there's a bit of a Robin Hood dynamic where they look at corporations as being these greedy kind of entities that are taking advantage of the rest of society. And quite frankly, the capital allocation approach of buying back shares has very little tax consequences. So they look at it as corporations trying to skirt by and not pay taxes while also taking advantage of underlying consumers, which is a pretty compelling argument in an election year for the electorate.
Austin, how do you look at that PCE number as it relates to portfolio construction?
It's an interesting one because it's coming down, and I would say that the Fed would probably indicate that it's on path. From a portfolio perspective, though, we pay a little less attention to that and more to what's going on with the underlying companies. The Fed has had such a significant influence on the market recently. Everyone seems to be uber focused on these macroeconomic variables. But at the end of the day, once you get the Fed out of there, once interest rates stop being the main driver of future returns, you'll see that corporate fundamentals matter more. And so we tend to focus more on the fundamentals, but we have to have an eye on what the Fed's seeing to understand where they might be taking rates in the future, just because, they've been such a significant driver of rates over the past, I guess, since 2008, 2009. We have to watch it because it's something that everyone else seems to watch, but we kind of take it with a grain of salt.
So, Austin, our first topic's around private credit. It's been a really hot topic lately, both in the traditional media and on Twitter. What's your take?
Yeah, it's been a really hot sector for a couple of reasons. First, because you've seen a number of asset managers who have historically been in the institutional space opening it up to retail, which is creating a lot of excitement. And from a fundamental perspective, you had the major money center banks who were crying foul. I think Jamie Dimon about 12 months ago was making a big deal about the point that private credit lenders were going to be eating their lunch because they didn't have the same capital requirements that banks do following the renewed capital requirements that were coming out this year. Well, a couple of things have changed since then. First, almost every asset manager on the street seems to be launching a private credit fund right now. There are literally tens, if not hundreds of billions of dollars entering this new asset class. And at the same time, we have the regulators saying that they might not be as restrictive on capital requirements for banks. So we have a situation where you have a lot of money chasing the same pool of assets. And we're actually starting to see some cracks in this environment as we're seeing many private credit lenders start to pull or start to reduce the restrictions on their covenants. Just last week, Bloomberg had an article citing how they're seeing a number of private credit deals being done with synthetic PIK interest payments. This is a whole new term. I had to look it up to figure out what it is. Basically, it means they're not requiring as restrictive of policies on lenders when they lend to them. As this would indicate, there's a lot more money chasing far fewer assets in the space. It's likely going to be a tailwind that turns into a headwind, and investors should think twice before allocating money to this space for the long term, as these vehicles tend to lock up people's assets for 5 to 10 years at best.
Yeah, I'm having shades of 2008. Adam, what's your take on it?
Yeah, it's another one of these sort of scary data points where you think about how well the economy has held up over the last few years, because it feels like for 3 years now, a recession has been about to start, and then it has been pushed back because of a very resilient economy. And it does feel like that can't last forever, and you're starting to see some cracks in the armor. And the question is, how big do those cracks get? And at some point, does the economy just explode? Because there is the idea that the longer you wait for that pullback, the harsher it could be.
Yeah. And Austin, I've heard you say a couple of times that portfolio managers always seem to be fighting the last recession and what caused it. So we don't want to spend too much time on it, but it seems to be a pretty big issue today. Is that fair?
I would say it's fair. I think that private credit is kind of a newer asset class. It's been around for some time in different forms, whether it be through BDCs or through bank lending. But essentially, when Dodd-Frank came around following the global financial crisis, they had to look for a new vehicle to take these assets off of the bank's balance sheets. And that's what created this massive private credit environment, or private credit sector, I should say. And so as we look forward, it might not be what blows up the economy. It does seem like the risk reward is not in investors' favor at this point, and there's other places to get return. So we wouldn't be so infatuated with double-digit returns from private credit when most of the historical track record happens to be in a time of growing economy with declining interest rates. As we see these higher interest rates kind of flow through and impact the rest of the economy, we could see some turmoil in the private credit space, which doesn't bode well for people who have their money locked up in those funds for 10 years at times.
That's right. Adam, our next topic is on consumer spending. It's been all over the news this cycle. What's your take?
Yeah, well, I think it was the phrase Austin used just a second ago. I thought was very good. A tailwind that could turn into a headwind. And what struck me about the U.S. consumer is when you think about what's driven the economy over the last little while, it's been consumer spending and government spending. And notably, last week at a conference, Brian Moynihan, the CEO of Bank of America, was talking about the consumer. And he said that if you compare this past May to last year, so May 2024 to May 2023, you see a slowdown. And a money center bank like B of A has a pretty unique insight because they're seeing money go from the consumer into the economy. They see ATM withdrawals, people writing checks, debit card transactions. And he said that this May, the growth in that money going into the economy from the consumer was about 3.5%. And you think, oh, that sounds pretty good. But last year at this time, it was 10%, which means that it's fallen by more than half. Again, just another data point to start piling on the data points that suggests that things are slowing.
Yeah. So subjectively, I live in the suburbs of Atlanta. There's a very popular restaurant that you can never walk up to and get a reservation. It's a little bit of a higher end restaurant, but not on the extreme level. And Friday, we just took a shot, walked up to it, and it was half empty. One of the most popular restaurants in the suburb I live in Atlanta.
I did not know you liked Arby's, but
Austin, what's your take on consumer spending?
Yeah, as I kind of referenced before, I think it's a really interesting environment. The consumer seems to have been strong, mainly because there was a ton of stimulus that was pumped into the economy that kind of put them in an unprecedented position, at least in the last kind of 40 to 50 years, where they had much less debt than historically was the case, and they also had a lot of cash. And we're seeing that kind of wear down. You're seeing that consumer balance sheets get a bit more stretched. And it should also be kind of apparent through the fact that the government is trying to pump more money into the economy during the election year. So they're doing things like forgiving student loans. I think I saw a number this morning saying that something around the like 130 to 150 billion dollars of student loans have been forgiven over the last 3 years. That's an unheard of amount of money that's literally going into people's pockets because they thought they had to save in the past and they no longer have to going forward. And that's obviously what's kind of boosted the economy recently. It's unclear where that next kind of slug of stimulus is going to come from. And I think as consumers start to get fearful that they're not going to get some new gift from the government, they may be less likely to spend and lever up and go borrow on credit cards. Another stat I saw last week, I think, was that the average credit card's charging 26% interest right now. That's just absurd. I mean, in 4 years, you're going to have to pay back more than you actually borrowed. And I think as people start to realize that, you're going to see a pullback in credit usage, which is obviously bad for consumer spending.
And Jay, just to add another anecdote, like I've talked to so many people that work in the service industry, and we are a service-based economy. And these are people that lost their jobs in 2020, got on unemployment, and then made more money that year on unemployment than they ever had before in their lives. And look, I don't want to debate the pros and cons of a social safety net. My point is just that doesn't last forever. And now that that's gone, and for a while they had some savings, and then that got pumped into the economy, and then they started, as to Austin's point, using their credit cards because they'd gotten used to a certain level of spending, and then inflation started eating away at what their purchasing power of that was, and here we are now, sort of where it feels like we are on the precipice of a shift where the consumer could just no longer power this thing.
It's interesting too. Like I think a few years ago, there was this whole modern monetary theory push basically saying that like the government can issue as much debt as they want because people just trust that they'll pay it back and will grow the economy to be able to pay it back. And everyone kind of laughed it off and thought that it wasn't that big of a deal. And it does seem like the federal government is pursuing modern monetary theory, even if they're not calling it that. I think any serious economist or investor would say that it's a joke and it won't work. But it does seem like the government is pursuing it because that's the way to get reelected in the current environment.
40% of all dollars in the market today were created in the last 4 years. I mean, the charts tell the story. Next topic, would it really be a show about investing if we didn't talk about AI? Today at the Computex conference, AMD revealed a new AI chip. NVIDIA yesterday unveiled its next generation of AI chips named Rubin to succeed the previous one called Blackwell, which was just announced months earlier in March. Guys, what's your take on the marketplace today, and can NVIDIA be dethroned?
Well, first of all, where do they come up with these names? Blackwell or Rubin? Like, what's next? Pastrami? I don't know. And NVIDIA also said that they're going to come out with a new architecture every year, and it does feel like this is a technology that the stock valuations notwithstanding, it feels like we're still early days in the actual technology, and so it doesn't surprise me that they're going to be offering new more sophisticated, more advanced chips with a very regular cadence. Not dissimilar to Apple releasing a new iPhone every year. They're probably working on the next 3 or 4 iterations as we speak, and it's a very savvy business move to kind of have an annual release party. At some point, like anything else, the curve starts to flatten, and it becomes harder to make as significant jumps. But my understanding of Rubin is it might use less power than Blackwell, so that's a good thing. I don't think it changes the need for an incredible amount of energy to run these things, but it seems like a normal process with a new technology.
Listen, I think it's nearly impossible to call who's going to be the long-term winner in AI. Just like it was nearly impossible to call who was going to be the long-term winner in the internet. If you absolutely have to play AI and you have to be owning that long-term winner, your best bet is probably to spread your bets out pretty broadly and hope that you own the long-term winner, even though it's likely to drop 50 to 60% or more at some point while you own it. Now, another way to think about this market is not to look for the guy or the company that's going to develop the chip that every AI data center has to have, but look for the companies that are going to be supplying those data centers. So it doesn't matter if Microsoft, if Meta, or if Alphabet wins the day. It doesn't matter if it's NVIDIA or if it's AMD. Look for the guys who are providing power to these data centers. Look for the guys who are providing the connectivity for the data centers. You can often buy them at reasonable valuations. And if AI does turn into the massive tailwind that everyone's expecting, you'll benefit as those fundamentals improve because you're not overpaying. The problem in the market today is people seem to want to pay sky-high valuations, assuming that these companies are going to grow indefinitely at extreme rates, and it's proven not to be true. If you're a $2 or $3 trillion company today, if you double or triple over the next couple of years, I mean, how many people truly believe that these companies should be $10 trillion companies? It was only a couple of years ago that people were going crazy over the first $1 trillion company, and now it's seen as kind of a happenstance, or it's not a big issue when companies hit 3 trillion or 2.5 trillion. It's kind of absurd when you think about it, and investors should be more thoughtful on how they play these trends going forward.
And I would just add to that, there also are going to be companies out there that announce that that their margins have gone up because of productivity gains, because of their use of AI. And I don't think we've seen that in bulk yet, and it might be hard to identify. But if the companies utilizing these tools don't actually benefit financially, then the whole house of cards comes falling down. But when you start to see companies announcing like, oh, our gross margins or our operating margins went from 20 to 25%, and the only difference is that we implemented these AI tools, then the whole market's going to shift to see, oh, who's going to really benefit at the as a customer of the NVIDIAs and the AMDs. I'd also say this: it doesn't feel like NVIDIA is Pets.com. It feels like the real question is how many players are there going to be, and can they maintain this 80-90% market share, which historically almost never happens?
Yeah, I think another thing to think about, and one of the things we really try to focus on, is where's the cash going in these situations. And so when you look at the big investors in data centers, right, you've got Microsoft, you've got Amazon, you've got Alphabet, you've got Meta. They're all putting 10 billion plus into data centers going forward. A lot of that's actually going into NVIDIA chips because NVIDIA can essentially tell them how much they're going to cost. They can turn to someone else if they choose not to pay. But in reality, what could be going on, and I'm not saying that this is what is going on, but what could be going on is most of these large tech companies have nowhere else to put their money. For the last decade, they've been buying smaller companies to expand their moat relative to the rest of the market, and they can't do it anymore because the federal government's essentially put a stop to acquisitions in the broader technology space. And so with that in mind, we saw $120 billion announced in buybacks in the last month. Outside of buybacks, the only thing these guys can do, aside from paying dividends, which they don't really like to do, is to go plow money into trying to develop a broader moat. So they'll put any amount of money into building out these data centers, whether it means it's going to contribute to long-term profitability or not. I would say it's still questionable if there's going to be any incremental free cash flow that comes off of the tens of billions of dollars that are being invested in the AI data centers. And that could be an issue for these companies going forward if they can't keep the same growth profile that they've had historically.
Well, Austin, you correctly called a while back the power of investing in utilities to play off of AI. Is that still something investors should consider today?
Yeah, I feel like it's like we maybe got the consolation prize at best on that one because we called the trend, but we didn't have the exposure that I would have loved to have had, mainly because we were concerned about the broader economy. And so we called the trend. We owned utilities. We're a little bit more focused on regulated utilities than unregulated utilities. In reality, the big beneficiary here is the unregulated power generators who are signing deals with the data center companies. So they're going directly to Alphabet. They're going directly to Amazon and signing long-term power price agreements with those companies, locking in long-term economics. It's a great business because they're able to flex up their pricing with demand, unlike regulated utilities. So there is a bifurcation in the utility space right now. Focus on the power producers who have the ability to increase pricing as demand from the big tech companies increases. In particular, look for those utilities that have green energy because it does seem like most of these companies are trying to sign contracts for green generation. So it's an opportunity. You have to be kind of thoughtful in how you participate. Some of the merchant power producers are up, more than NVIDIA this year, which is surprising. But there are still some opportunities under the radar, which I think people aren't necessarily paying attention to. And those are the opportunities that we're buying in our different vehicles.
Our last topic, GameStop, is back in the markets, roaring as much as 80% last week. And influential influencer Roaring Kitty was out posting about it again. Adam, what's your take?
Look, this is ridiculous. I mean, this Roaring Kitty. I'm not sure if Roaring Kitty should be arrested for, stock manipulation, or should be put on a pedestal because he's revealing the idiot brigade of people. He posted a meme of an Uno card, and it made the GameStop, which arguably might not even be a real company, go up 80%. I mean, it's insane. And then the headlines talk about how he may have taken a $150 million position. But then you look at it, it's via options. So he's not risking $150 million. What I want to know is what did he do that he needs more money after the last go around of this? I mean, there was a movie made called Dumb Money about what he did, and people are still buying into this stuff. And look, a couple people will ride that 80% and sell and have more money than they started with. Good for them. And then most of these morons will lose everything and go back into their parents' basements and start playing Fortnite again. It's ridiculous. I'm not well versed on the nuance of stock manipulation law, but give me a break. Don't. I guess the lesson here is just don't chase this game. If you owned GameStop before this happened and you just made 80%, good on you. Don't buy it now. You're just gonna get your face ripped off, and it's unfortunate that one person, without even saying what he's doing, he posted a picture of an Uno card. What is that? And then people just decide that means that he's, I don't know, people get mad when Warren Buffett announces that Berkshire bought a company and the stock goes up 4%. GameStop's up 80% because someone named Roaring Kitty may or may not have a position. It seems ridiculous, but good luck to all of you buying GameStop today. I hope it works out.
Not just that. I mean, if you look for what the SEC looks for in insider trading, it's options, because that's the best way to get leverage to the upside. And this guy literally bought a bunch of options and then posted that he bought a bunch of options and posted an Uno card. And people go nuts, and he makes, hundreds of millions of dollars. It's the most ridiculous thing ever. I think from an investor perspective, if you're buying companies or if you're focusing on share price to justify buying or selling something, you're probably not qualified to be making decisions on your investing. You should turn it over to true professional investors who can look at the underlying fundamentals, identify if it's truly an opportunity or not an opportunity. Because if you're just making decisions based on share prices, you're gonna get your face ripped off, right? You look at everyone that's investing based on some tweets or posts on Reddit or whatever it is, and they're asking to get their faces ripped off. Warren Buffett says that you never win a baseball game by staring at the scoreboard. And what these people are doing is they're staring at the scoreboard, hoping to win the World Series. It's ridiculous. It makes no sense. If all you know how to do is watch a stock price movement, you should probably turn your investing over or your savings over to professionals who understand how to value companies.
Also, if the core investment thesis is I think there are people out there dumber than me. I mean, come on, right? Because what Roaring Kitty's really doing here is saying, I think a lot of you out there are stupid. And he's right.
Gentlemen, we'll end on that. Viewers, listeners, if you would like to submit a question to the team, send us an email, podcast@opalinvest.com. Scan the QR code on the screen, and make sure you check out Opal Capital at opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.